There is a ghost in the machine of modern business. It's a phantom that haunts boardrooms, a specter that spooks investors, a whisper that promises brilliance and delivers ruin. That ghost is complexity. We have been taught, conditioned, from our first business class to our latest market news update, that complexity is the hallmark of sophistication. We are told that the most disruptive companies have intricate algorithms, that the most visionary leaders manage sprawling, multifaceted empires, that the biggest returns lie hidden in the labyrinthine code of a business model so advanced that only a select few can truly comprehend it. We chase the complicated, believing it holds the key to wealth, and in doing so, we walk directly into a trap that has cost investors trillions of dollars. A trap that ensures most people will never achieve true financial freedom. Because the most powerful secret in the world of investing, the foundational principle upon which the greatest fortune of the modern era was built, is the exact opposite. The secret is simplicity. Warren Buffett, the architect of that fortune, has spent a lifetime not in search of the next impossibly complex breakthrough, but in search of businesses so simple, so fundamental, so powerfully straightforward, that they could be run by a child. This isn't a quaint folksy saying. It is a weaponized financial strategy. It is a calculated rejection of the allure of genius and a devout commitment to the power of the system. It is a filter that eliminates 99% of investment opportunities, and in doing so, isolates the 1% that are truly built to last. The costly mistake this prevents is betting on the jockey instead of the horse. It saves you from the catastrophic risk of a business whose success is precariously balanced on the shoulders of a single, irreplaceable superstar, a manager, a founder, a visionary. Because genius is fragile. Genius is unpredictable. Genius can leave or burn out or make a fatal mistake. A great business model, however, is durable. It is resilient. It is an engine of profit that runs on its own inherent logic, not on the heroic efforts of one person. Over the next hour, we are going to dismantle this principle and rebuild it inside your own mind. This is not just a lesson in stock picking. It is a fundamental rewiring of how you perceive value. You will learn to prioritize the quality of the business itself over the perceived brilliance of its current leadership. You will learn to hunt for companies that possess a durable competitive advantage so profound, so deeply embedded in their structure, that they can not only survive mediocre management but can thrive for decades, generating passive income and building generational wealth with a quiet, relentless certainty. This is the path to financial resilience. This is the final promise of value investing. This is how you stop betting on people and start investing in inevitability. Pillar 1. The Fortress Business Model. Simplicity as the ultimate sophistication. The year is 1983. The city is Omaha, Nebraska. It's a place far from the frantic energy of Wall Street, a world away from the high-stakes games of private equity and leveraged buyouts. And in a modest office in Kiewit Plaza, Warren Buffett is about to make one of the most important investments of his career, an investment that would become a parable for his entire philosophy. There were no spreadsheets, no teams of analysts, no convoluted financial models. There was just a conversation, a handshake, and a deep understanding of a profoundly simple business. The business was the Nebraska Furniture Mart, and its founder was a woman named Rose Blumkin, a tiny, indomitable Russian immigrant who had arrived in America without a dollar to her name and unable to speak a word of English. They called her Mrs. B, and she was a local legend. She had started the business in 1937 in the basement of her husband's pawn shop with a $500 loan. Her business model was so simple it was almost insulting to the complex strategic frameworks being taught in business schools. It was this: sell cheap and tell the truth. That was it. That was the entire strategy. She bought furniture directly from manufacturers, cutting out the middlemen. She operated with razor-thin margins, piling it high and selling it cheap. She was relentless about costs, living by the mantra that every penny saved was a penny earned for her customers. And she was pathologically honest. Her word was her bond. In a world of slick salesmen and bait-and-switch tactics, Mrs. B's transparent honesty was its own form of disruptive technology. By 1983, the Nebraska Furniture Mart was the single largest home furnishing store in the United States, doing over $100 million a year in sales, an absolutely staggering figure for a single location in Omaha. It dominated its market with an intensity that baffled national chains. They couldn't compete with her. Her cost structure was too low, her reputation too sterling, her connection with the community too deep. Buffett had watched her for decades. He was not just an investor, he was a customer. He saw the fortress she had built. It wasn't a fortress of patents or complex technology. It was a fortress of simplicity and trust. So one day, he went to see her. He walked into the store, found the 89-year-old matriarch zipping around on her electric scooter, and made his pitch. He didn't ask to see a decade of audited financials. He didn't demand projections. He asked her a few questions about her competitors and her margins. He knew the business model was sound because he could see it in action. He saw the packed parking lot. He saw the low prices. He understood the economics instantly. He asked her how much she wanted. She named a price, $60 million. Buffett thought for a moment. He knew the business was worth far more. He said yes. The deal was formalized on a one-page contract. Buffett didn't even conduct an audit. He later joked, "We gave Mrs. B a check for $60 million, and she gave us her word. And of course, she was good for it." Why did he do this? Why bet so much on such a seemingly unsophisticated local business? Because Buffett understood that its simplicity was its strength. He could hold the entire business model in his head. Buy cheap. Operate efficiently. Sell cheap. Be honest. There were no complex variables. He didn't need to worry about technological obsolescence, changing consumer fads, or regulatory shifts. People in Omaha would always need furniture, and they would always be drawn to the lowest prices and an honest seller. The business didn't depend on Mrs. B's unique genius to function, even though she had built it. It was now a system, a process, a culture. The economic moat was so wide and deep that a competitor would have to be willing to lose money for years to even attempt to challenge it. That handshake deal for the Nebraska Furniture Mart became a cornerstone of Berkshire Hathaway. It was a testament to the idea that the most powerful investments are often the ones you can understand completely, the ones whose success is derived not from a secret formula, but from the flawless execution of a simple, universal truth. It was the ultimate proof that in the world of long-term investing, sophistication is not complexity, it is clarity. The magnetic pull of complexity is one of the most powerful and expensive traps in modern finance. Our brains are wired to equate intricacy with value. A physicist scribbling complex equations on a chalkboard seems more brilliant than a farmer describing the simple cycle of planting and harvesting. A tech CEO describing a multi-layered software-as-a-service ecosystem seems more visionary than a candy manufacturer explaining how they make caramel. This is a cognitive bias known as complexity bias. We instinctively assume that a complex solution is a better solution, and that a complex problem requires a complex answer. This bias is exploited everywhere, from consulting firms that produce 1,000-page reports to justify their fees, to fund managers who use esoteric jargon to obscure mediocre performance. In investing, this bias manifests as a dangerous attraction to businesses we don't fully understand. We see a company with a sprawling patent portfolio in a cutting-edge field like gene editing or quantum computing, and we feel a sense of awe. The very fact that we can't grasp the details makes it seem more promising, more likely to be the next big thing. We mistake our own confusion for the company's sophistication. Warren Buffett's strategy is a direct assault on this bias. He leverages a countervailing psychological principle, cognitive fluency. Cognitive fluency is the subjective experience of ease or difficulty associated with a mental task. Simply put, Our brains prefer things that are easy to think about. When a business model is simple, like the Nebraska Furniture Mart's sell cheap and tell the truth, it possesses high cognitive fluency. We can process it effortlessly. This isn't a sign of intellectual laziness, it's a gateway to superior decision-making. When a concept is fluent, our minds are not bogged down in the effort of just trying to understand it. Instead, all of our mental resources can be dedicated to evaluating its merits, its risks, and its long-term viability. We can ask the right questions because we're not struggling with the basic vocabulary. With a simple business, Buffett can immediately jump to the crucial inquiries. What are the margins? What is the return on capital? How strong is the brand? What could go wrong? For a complex biotech firm, an investor might spend 90% of their energy just trying to understand the science of a single drug in its pipeline, leaving little capacity to assess the dozens of other variables that will determine its success. This leads to another dangerous bias, the illusion of control. When investors spend weeks deciphering a complex company's annual report, they begin to feel that their effort has given them a special insight, a level of control over the outcome. They believe they have cracked the code, but what they have usually done is mastered the jargon, not the underlying business reality. They've learned the language of the company, but they still have no real ability to predict whether its technology will work, whether its market will materialize, or whether a competitor will render it obsolete overnight. Buffett's preference for a simple business is an act of intellectual humility. It's an admission that the future is fundamentally uncertain, and that the more moving parts a machine has, the more ways it can break. By sticking to businesses that are easy to process, he maximizes his cognitive fluency, allowing for a clearer, more rational analysis. He avoids the illusion of control by acknowledging what he doesn't know, and refusing to play in games where the rules are too complex or subject to rapid change. He knows that in investing, your biggest enemy is not the market, it is your own brain, with its flawed wiring and its love for seductive, complicated stories. The fortress of simplicity is not just a business strategy, it is a psychological defense mechanism against the most expensive mistakes an investor can make. So how do you translate this powerful principle into a practical, repeatable process? How do you build your own fortress of simplicity in a world that constantly bombards you with complexity? The answer lies in one of Buffett's most famous mental models, the circle of competence. This isn't just an abstract idea. It is a blueprint for action, a step-by-step method for filtering the investment universe down to a manageable and understandable domain where you have a genuine edge. Step 1 is the personal inventory. Take out a piece of paper or open a new document. The goal here is not to list what you want to know, but what you already know deeply and intuitively from your life experience. Divide the page into 2 columns. In the first column, list your profession and industry. If you're a software engineer, write that down. A doctor, a plumber, a teacher, a marketing manager for a consumer goods company. Be specific. What do you do for 40 hours a week? You have a ground-level understanding of the economics, the competition, and the customer behavior in this field that no Wall Street analyst can match. In the second column, list your hobbies and passions. Are you a passionate home cook? You understand the economics of grocery stores, appliance brands, and food producers. Are you a car enthusiast? You understand the brand loyalty, the supply chains, and the maintenance costs associated with automotive companies. Are you a gamer? You have a deep insight into the world of game publishers, hardware manufacturers, and streaming platforms. This initial list forms the outer boundary of your potential circle of competence. Step 2 is the one-sentence test. Now, for each item on your list, you must subject it to a ruthless test of clarity. Can you describe the fundamental business model of a company in that industry in a single, simple sentence? For example, for a railroad, it transports essential goods from point A to point B over a fixed network for a fee. For a soft drink company, it sells a branded syrup concentrate to bottlers, who then distribute the final product to retailers. If you find yourself using jargon, complex clauses, or words like synergy, platform, or ecosystem, you have failed the test. The business is likely too complex. This test forces you to prove your understanding. As Einstein famously said, if you can't explain it simply, you don't understand it well enough. This is the first filter that separates a truly simple business from one that is merely familiar. Step 3 is identifying the key profit drivers. Once a business passes the one-sentence test, you must be able to list the 2 or 3 critical variables that determine its success. For that railroad, it might be fuel costs and freight volume. For the soft drink company, it might be the cost of sugar and advertising effectiveness. If you have to list 10 or 20 variables, or if the key variables are unknowable technological breakthroughs, then the business is too unpredictable. A simple business has a simple profit formula. Understanding this is essential for effective stock picking and risk management. Step 4 is the 10-year test. Look at the business and ask yourself a powerful question. Can I, with a reasonable degree of confidence, predict what this industry and this company's competitive position will look like in 10 years? For a chewing gum company, the answer is likely yes. People will still be chewing gum. The brands will likely be the same. For a company on the bleeding edge of artificial intelligence, the answer is almost certainly no. The landscape could be unrecognizable in just a few years. This test is the ultimate guardrail of long-term investing. It forces you to invest in enduring realities rather than speculative possibilities. By rigorously applying this 4-step process, you are not limiting your opportunities. You are focusing your power. You are defining the battlefield where you can fight with an advantage. Most investment losses come from straying outside this circle, from being lured by the siren song of a complex story you don't truly understand. Building and respecting your circle of competence is the most fundamental act of financial self-defense an investor can take. It is the practical application of valuing a simple business model, and it is the first step toward building a truly resilient portfolio. The path of the 99% is paved with a wreckage of complicated ideas. The average investor, driven by a cocktail of media hype, fear of missing out, and a desire to appear sophisticated, consistently makes the same fatal error. They chase the story stock. A story stock is a company whose investment appeal is based almost entirely on a compelling narrative about the future, rather than on a proven and understandable business model in the present. This narrative is almost always complex, futuristic, and intoxicating. Think back to the dot-com bubble of the late 1990s. Companies with no profits, no clear business model, and often no real revenue were valued in the billions of dollars. Why? Because they had a story. They were going to revolutionize pet food delivery or create a new paradigm in online grocery shopping. The stories were complex, filled with jargon about eyeballs, stickiness, and first-mover advantage. Investors didn't understand the underlying economics because there were none, but they understood the story. They bought the narrative, not the business. The result was a catastrophic loss of capital, a cleansing fire that wiped out an entire generation of naive investors. The names change, but the behavior remains the same. In recent years, we've seen it with speculative biotech firms. These companies often have a captivating story about curing a terrible disease. Their presentations are filled with complex diagrams of molecular interactions and data from Phase 1 clinical trials. The average person has no hope of independently verifying these claims. They are betting entirely on the story, on the hope of a breakthrough. They are investing in a lottery ticket with a PhD. We see it in the world of fintech, where companies with convoluted revenue models based on payment flows, data monetization, and interchange fees are sold with a simple, slick user interface. The investor sees the easy-to-use app but doesn't grasp the fragile, low-margin, and intensely competitive business that underpins it. They are buying the facade, not the foundation. The antithesis of Buffett's approach is to start with the story and then try to justify the investment. Buffett starts with the business model. If he can't understand the business in 5 minutes, he moves on. The 99% will spend 5 weeks trying to understand a complex business, and in the end, their desire to have not wasted their time will trick them into investing. This is a classic example of commitment and consistency bias. This path is so tempting, because it feels like being on the inside. Understanding, or believing you understand. A complex story stock makes you feel intelligent, forward-thinking, a part of the future. Buying shares in a boring, simple business like a brick manufacturer or a garbage collection company feels pedestrian. There's no exciting story to tell your friends at a dinner party. Yet the brick manufacturer has a clear business model, a local economic moat, and predictable demand tied to construction cycles. The garbage collection company operates on long-term municipal contracts, an essential service that produces recurring, utility-like revenue. These are the types of businesses that build quiet, generational wealth. The disastrous consequence of chasing the complex story stock is not just the potential for a 100% loss, it is the opportunity cost. The time, energy, and capital wasted on deciphering and investing in speculative narratives is capital that could have been compounding steadily and safely in a high-quality, simple business. It is a fundamental failure of personal risk management. The 99% are playing a game of what if, hoping to catch lightning in a bottle. Buffett is playing a game of what is, investing in the durable realities of a simple, profitable business model that has proven itself year after year. The choice between these two paths is the single greatest determinant of an investor's long-term success. The profound financial advantage of a simple business model crystallizes on the financial statements in the form of one critical attribute: predictability. The entire practice of valuation, the very heart of value investing, is an attempt to estimate the sum of all future cash flows a business will generate, and then discount them back to the present. For a business with a complex, rapidly changing model, this is an exercise in pure guesswork. The range of potential outcomes is enormous. A tech company might conquer the world, or it might be rendered obsolete by a new innovation in 18 months. A biotech firm might discover a blockbuster drug, or it might burn through all its cash and go bankrupt. When you try to model the future cash flows of such a company, your spreadsheet becomes a work of fiction. The assumptions you have to make are so numerous and so uncertain that the final valuation number is virtually meaningless. This uncertainty is risk, and the market prices this risk accordingly, leading to wild volatility and a high cost of capital. Now consider a simple business, one that passes the tests of the circle of competence. Consider a company like McCormick & Company, which sells spices. The business model is stunningly simple. They source, package, and sell branded spices to consumers and businesses. What will this business look like in 10 years? It will look almost identical to how it looks today. People will still be using salt, pepper, and paprika. The brand is trusted. The distribution network is established. The business has a durable competitive advantage. When you sit down to value a company like this, the exercise is transformed. The range of potential outcomes narrows dramatically. You can look at the past 20 years of revenue growth, margin stability, and capital expenditures, and you can project the next 10 years with a much higher degree of confidence. Your discounted cash flow, DCF analysis, is no longer fiction. It is a reasonable estimate grounded in a long history of stable operations. This predictability has a direct and massive impact on your portfolio strategy. Because you can value the business with more certainty, you can act with more conviction. When the market panics and the stock price of your simple, predictable spice company drops by 30%, you don't panic with it. You can confidently look at your valuation, see that the price is now well below the intrinsic value, and buy more. You are acting on reason, not emotion. The investor in the complex tech stock has no such anchor. When their stock drops 30%, they are paralyzed by doubt. Was there a news event they missed? Is the technology already obsolete? Is the story falling apart? They have no reliable way to value the business, so they are at the mercy of the market's manic depressive mood swings. This stability and predictability directly contribute to long-term financial resilience. A portfolio built on a foundation of simple, understandable businesses is an all-weather portfolio. It may not capture the dizzying highs of a speculative frenzy, but it will also avoid the catastrophic lows that follow. Over a multi-decade investing career, this avoidance of permanent capital loss is far more important then capturing every last bit of upside. The simple business model translates into a balance sheet with less leverage, an income statement with more consistent margins, and a cash flow statement that shows a steady stream of distributable cash. This is the financial bedrock upon which true passive income and lasting wealth are built. It is the tangible, quantifiable reward for rejecting the siren song of complexity and embracing the profound power of a simple, durable business model. Pillar 2. The indispensable product, the power of unchanging human habits. In 1972, Warren Buffett and his partner Charlie Munger were presented with an opportunity to buy a small, family-owned candy company based in California. The company was called See's Candies. On the surface, it seemed like a decent but unremarkable business. It sold chocolates and other confections through its own retail stores. The asking price was $30 million, but Buffett and Munger, disciplined in their value investing approach, were only willing to offer $25 million. The sellers, the See family, initially refused. At this point, many investors would have walked away. The numbers didn't quite work, but a friend of Buffett's, a man named Ira Marshall, urged them to reconsider. He understood something about See's that didn't show up on a balance sheet. He understood the power of the brand and the product in the minds of its customers. Buffett and Munger, prompted by this advice, took a deeper look. What they discovered was not just a candy company. It was a deeply ingrained cultural institution. See's Candies wasn't just a product people bought. It was a part of their lives. People bought See's for Valentine's Day, for Mother's Day, for Christmas. Giving a box of See's was a gesture of affection, a tradition passed down through generations. Customers had a powerful emotional connection to the product. They trusted the quality. They loved the experience of walking into the black and white checkered stores. This emotional bond gave See's an extraordinary power, pricing power. The cost of the raw materials, sugar, chocolate, nuts, was only a small fraction of the retail price. The rest was pure brand value. See's could raise its prices by 10% every year, and no one would even consider switching to a cheaper generic brand for their Valentine's Day gift. To do so would be to signal that you didn't care as much. The product was indispensable, not for physical survival but for social and emotional rituals. Munger, in particular, recognized this as a powerful economic moat, a durable competitive advantage that was almost impossible for a competitor to replicate. A new company could make identical-tasting chocolate, but it couldn't create 50 years of happy memories and family traditions overnight. Convinced, they agreed to the sellers' final price of $25 million, a price that was 3 times the company's book value and seemed expensive at the time. That $25 million investment has since been called the prototype, the investment that transformed Buffett from a cigar-butt investor buying cheap, mediocre businesses to a quality investor buying wonderful businesses at a fair price. Since 1972, See's Candies has generated over $2 billion in pre-tax earnings for Berkshire Hathaway. All of that cash was produced without requiring significant additional capital investment. The recipes are largely the same. The stores look the same. The product is fundamentally unchanged. It is a gusher of cash, a testament to the incredible financial power of an indispensable product that has become a locked-in part of human habit. The See's Candies story is the foundational anecdote for understanding why Buffett prizes businesses whose products are deeply intertwined with the unchanging fabric of human life. It taught him that the most valuable asset a company can have is a sliver of real estate in the consumer's mind, a space reserved for habit, tradition, and trust. This is the essence of quality investing and the source of true, long-term passive income. The reason a business like See's Candies or Coca-Cola can become a financial juggernaut lies deep within our own psychology. It's rooted in a powerful cognitive bias known as the status quo bias. Humans are, by nature, creatures of habit and routine. We are wired to prefer things to stay the same. Change requires effort. It involves uncertainty. And our brains are fundamentally energy conservation machines. Given a choice, we will almost always opt for the familiar path, the known quantity, This bias governs countless decisions we make every day, from the brand of coffee we buy to the route we take to work. Companies with indispensable products become the beneficiaries of this deep-seated human trait. They become the status quo. When you're standing in a convenience store thirsty, the bright red Coca-Cola logo acts as a powerful mental shortcut. You've had it 1,000 times before. You know exactly what it tastes like. It's reliable. Reaching for a new, unknown beverage introduces a small risk. What if you don't like it? For most people, most of the time, it's simply not worth the mental energy to run that risk. They stick with the default. This process is reinforced by the neuroscience of habit formation. A habit is, at its core, a three-step neurological loop: the cue, the routine, and the reward. For a smoker, the cue might be finishing a meal. The routine is lighting a cigarette. The reward is the nicotine rush. For a consumer of an indispensable product, the loop is just as powerful. The cue for a Gillette razor user might be seeing their own stubble in the morning mirror. The routine is picking up the familiar Mach 3 handle and shaving. The reward is the feeling of a clean, smooth face. The company has effectively outsourced the routine part of the loop to its product. By doing this over and over, the behavior becomes automatic, moving from the conscious decision-making part of our brain, the prefrontal cortex, to the automatic habit-forming part, the basal ganglia. Once a habit is encoded there, it becomes incredibly difficult to dislodge. A competitor can't just offer a slightly better or cheaper product. They have to overcome the powerful inertia of the established habit. They have to convince the consumer to consciously break their ingrained routine and form a new one. This is an enormous marketing challenge. Buffett understands this on an intuitive level. He is not just investing in a company that sells sugary water or candy or razors. He is investing in millions of deeply ingrained neurological loops. He is buying a piece of the collective human habit. This is a far more durable competitive advantage than a patent, which can expire, or a technological edge, which can be duplicated. Habits, once formed, can last a lifetime. This is also why he is famously wary of technology companies. Technology, by its very nature, is a force of disruption. Its goal is to break old habits and create new ones. Investing in technology is a bet on change. Buffett's strategy with indispensable products is a bet on the opposite, a bet on the powerful, predictable, and profitable force of human inertia. He is investing in the things that don't change, because he knows that in the realm of human psychology, the status quo is a mighty and lucrative kingdom. How can you, as an investor or entrepreneur, systematically identify businesses built on this powerful foundation of habit and permanence? The mental model for this is known as the Lindy effect test. The Lindy effect is a theory of longevity that proposes that for certain non-perishable things, like a technology or an idea, every day they survive increases their future life expectancy. In other words, if a book has been in print for 50 years, it is more likely to be in print for another 50 years than a book that has been in print for only 1 year. We can apply this concept as a powerful filter for identifying indispensable products with a durable business model. Here is the step-by-step blueprint. Step 1 is the time travel test. Select a company and identify its core product or service. Now, travel back in time 20 years. Was the company selling essentially the same product to the same type of customer back then? Now, travel forward in your mind 20 years. Can you, with a high degree of confidence, see people still using this product in a largely unchanged form? A Mars candy bar passes this test with flying colors. A smartphone model from 5 years ago utterly fails. This simple thought experiment is your first and most powerful filter. It immediately weeds out businesses built on fleeting fads and rapidly evolving technology, focusing you on the realm of the permanent. Step 2 is the primal need audit. For a product that passes the time travel test, you must then identify the fundamental, unchanging human need or desire it serves. Great businesses are not built on technology, They are built on psychology. Wrigley's gum doesn't just sell a confection, it serves the need for oral fixation, fresh breath, and a small moment of stress relief. A beer company doesn't just sell a fermented beverage, it serves the primal human desire for social connection and relaxation. A company that makes ketchup serves our innate preference for combining sweet, salty, and savory flavors. If you cannot connect the product to a basic, enduring human need, its indispensability is likely an illusion. Step 3 is the grandma and teenager bridge. This is a practical test of a product's ubiquity and timelessness. Is this a product that both your grandmother and a modern teenager would recognize and use? Coca-Cola passes. A Heinz ketchup bottle passes. A deck of bicycle playing cards passes. This indicates that the product has transcended demographic and generational shifts, proving its deep integration into the culture. A product that is only popular with a single, narrow age group is far more vulnerable to changing tastes and trends. Step 4 is the pain of substitution analysis. Finally, imagine the product was suddenly unavailable. What would the customer do? How much friction or pain would be involved in finding a substitute? For many products, the substitution is easy and painless. If your local generic brand of paper towels is out of stock, you just buy another. But for a loyal See's Candies customer buying a gift, substituting with a box of chocolates from the supermarket feels like a significant downgrade. The emotional and social cost of substitution is high. For an architect who has used Autodesk software for 20 years, the cost of switching to a new system, in terms of retraining, converting old files, and workflow disruption, is immense. The higher the pain of substitution, the more indispensable the product, and the wider the company's economic moat. By applying the Lindy effect test through these 4 practical steps, you move beyond analyzing spreadsheets and start analyzing human nature. This is the core of quality investing. It allows you to identify businesses whose success is not a matter of chance, but a near certainty, anchored in the most predictable force on earth, the power of human habit. This is a crucial skill for anyone aiming to build a portfolio strategy based on long-term resilience and predictable returns. The overwhelming majority of market participants do the exact opposite. Instead of seeking the timeless, they chase the timely. They are the fad chasers, investors who are perpetually sprinting on a treadmill of trends, always trying to catch the next hot thing before it cools off. This is the path of the 99%, and it is a guaranteed recipe for long-term underperformance and high anxiety. The fad chaser's portfolio is a graveyard of yesterday's darlings. It's littered with the stocks of companies that were once the talk of the town, but whose core products were built on sand. Think of companies like GoPro. For a brief period, their small, durable cameras were a cultural phenomenon. The stock soared as investors extrapolated this explosive growth far into the future. They were buying the story of a new media empire. But the underlying product was a fad. Once, everyone who wanted a GoPro had one, and as smartphone cameras got progressively better, the market evaporated. The product was not indispensable, it was a novelty gadget. The stock collapsed, wiping out investors who had mistaken a trend for a permanent shift in behavior. We saw this with companies like Peloton during the pandemic. For a moment, their expensive stationary bikes and subscription classes seemed like the future of fitness. The story was compelling, and the stock skyrocketed. But the product was, for many, a high-cost substitute for a gym, driven by a temporary lockdown situation. As the world reopened, many realized their habit was not with the bike, but with the social environment of a real gym. The fad faded, and the stock price followed it into the abyss. The psychological trap for the fad chaser is the allure of rapid growth. A company built on an indispensable product, like a chewing gum company, might grow its revenue by a steady 4% a year. A company built on a hot fad can see its revenue grow by 200% in a year. This explosive growth is intoxicating. It generates exciting headlines and creates powerful narratives of disruption. It triggers a deep-seated fear of missing out, FOMO, in investors who pile in at the peak, blinded by the recent past's performance. The fundamental mistake the fad chaser makes is confusing a product's current popularity with a durable competitive advantage. They don't apply the Lindy effect test. They don't ask if the product is tied to a primal human need. They don't consider the pain of substitution. They are simply betting that the trend will continue indefinitely. This is not investing. It is speculation. It requires you to be right twice. You have to know when to get in, and you have to know when to get out. The long-term investor in a company with an indispensable product only has to be right once, at the time of purchase. The consequences of this approach are devastating. It leads to a portfolio characterized by extreme volatility. It forces the investor to constantly monitor the news, trying to stay ahead of shifting tastes. It is a high-stress, low-return strategy. The fad chaser is always paying for growth that has already happened, buying into the hype just as the smart money that identified the trend early is quietly selling out. This path stands in stark contrast to the calm, deliberate accumulation of ownership in businesses that have stood the test of time, businesses whose products are so woven into the fabric of our lives that their continued success is not a matter of speculation, but of simple observation. The direct financial manifestation of an indispensable product is one of the most beautiful things an investor can find on an income statement: pricing power. Pricing power is a company's ability to raise prices for its products or services over time without seeing a meaningful decline in customer demand. It is the ultimate sign of a strong business model and a wide economic moat, and it is the engine of superior long-term returns. Let's trace its impact directly through the financial statements. It starts on the top line: revenue. A company with pricing power can consistently increase its revenue year after year, even if the number of units it sells remains flat. Imagine two companies, Company A and Company B. Both sell 100 million units of their product at $1 each, for $100 million in revenue. The next year, due to 3% inflation, their costs for labor and raw materials go up. Company B, which sells a commoditized product with no brand loyalty, cannot raise its price. If it does, its customers will immediately switch to a cheaper competitor. Its revenue remains $100 million, but its costs have increased, so its profits shrink. Company A, which sells an indispensable habit-forming product like Coca-Cola, raises its price by 5% to $1.05. Because of its brand loyalty and the low pain of substitution, it loses almost no customers. Its new revenue is now $105 million. This 5% price increase flows directly down the income statement. It dramatically expands the company's gross margin, which is revenue minus the cost of goods sold. Because the price increase was greater than the cost inflation, the profit on each unit sold has increased. This in turn leads to a higher operating margin and ultimately a higher net profit margin. This ability to outpace inflation is the secret to real wealth creation. Businesses without pricing power see their margins relentlessly squeezed by inflation. Businesses with pricing power are able to pass on their own cost increases, plus a little extra, directly to their customers, effectively using inflation as a tailwind to grow their own profits. The financial benefits don't stop there. This consistent profitability and margin expansion lead to a very high return on tangible assets. A business like See's Candies or Coca-Cola doesn't need to constantly reinvest in new factories or massive research and development to maintain its competitive advantage. Its advantage lies in the intangible asset of its brand. Therefore, the profits it generates are not consumed by mandatory capital expenditures. They become free cash flow. This river of free cash flow, produced by the magic of pricing power, is what gives a quality management team its power. They can use that cash to pay dividends, creating a direct stream of passive income for shareholders. They can use it to buy back their own stock, increasing each remaining shareholder's ownership percentage of the business. Or they can use it to make intelligent acquisitions. This entire virtuous cycle, from an indispensable product to ingrained customer habit, to immense pricing power, to expanding margins, to massive free cash flow generation, is the financial blueprint for a compounding machine. It's how small investments grow into fortunes over decades. By learning to identify products that have this quality, You are learning to spot the genetic code of the world's greatest businesses. Pillar 3. De-risking genius, the dangers of keyman dependency. In the mid-1980s, Warren Buffett made one of the largest and most successful investments of his career. It wasn't in a sleepy consumer brand or a predictable utility. It was in the dynamic and often tumultuous world of media. He invested nearly $500 million to help a company called Capital Cities Communications acquire the much larger American Broadcasting Company, or ABC. To an outsider, this looked like a departure from his usual strategy. The media landscape was complex and subject to the whims of ratings and advertising dollars. But Buffett wasn't investing in the media industry. He was investing in a man and the system he had built. That man was Tom Murphy. Tom Murphy was the CEO of Capital Cities, and he was the antithesis of the celebrity CEO archetype. He was not a charismatic visionary who graced the covers of magazines. He was humble, unassuming, and almost pathologically frugal. He rarely gave interviews and focused relentlessly on operations. What made Murphy a genius in Buffett's eyes was not his ability to predict the next hit TV show, but his genius for building a resilient, decentralized organization. Murphy's management philosophy was profoundly simple. He believed in hiring the best possible manager for each business unit, be it a local TV station or a newspaper, and then getting out of their way. He gave them almost complete autonomy. He didn't believe in massive corporate headquarters staffed with layers of bureaucracy. The entire Capital Cities head office consisted of just a handful of people. His primary role, as he saw it, was to set a culture of extreme cost consciousness and to be an intelligent allocator of the capital that the various businesses produced. He created a system, not a personality cult. The success of a Capital Cities TV station in Albany didn't depend on Tom Murphy's daily involvement. It depended on the local manager, who was empowered to make decisions, and on the proven, repeatable playbook of lean operations and community focus that Murphy had instilled throughout the organization. This was the key. Buffett saw that Capital Cities was not dependent on Tom Murphy's personal brilliance for its day-to-day success. It was a machine that Murphy had designed and built, a machine that could largely run itself. He was betting on the durability of the system, not the stamina of the man. Buffett's investment in Capital Cities/ABC was a massive success, netting Berkshire Hathaway a multi-billion-dollar profit. Years later, when asked about his management heroes, Buffett would consistently place Tom Murphy at the top of his list, calling him the best business manager I've ever met. The foundational lesson from this anecdote is subtle but critical. Buffett does invest in great managers, but he defines, quote, great, in a very specific way. A great manager is not a superstar who makes every critical decision. A great manager, in the Buffett-Murphy mold, is a master architect of systems and culture. They work to make themselves progressively less essential to the organization's functioning. They build a business that can survive and thrive long after they are gone. This is the ultimate form of risk management. By investing in a company like Capital Cities, Buffett was de-risking the element of human genius. He was buying a resilient, self-sustaining business model that was run by a superb manager, but not wholly dependent upon him. It was a business an idiot could run, and because of that, it was a business that could endure. Our brains are deeply susceptible to the allure of the heroic individual. From childhood, we are fed stories of great kings, brilliant generals, and visionary inventors who single-handedly changed the course of history. This narrative bias carries over directly into how we evaluate businesses. We are drawn to the story of the charismatic, visionary CEO who is revolutionizing an industry. This psychological phenomenon is known as the halo effect. The halo effect is a cognitive bias where our overall impression of a person influences how we feel and think about their specific traits. If we perceive a CEO as being charismatic, articulate, and confident in a television interview, we are likely to subconsciously assume they are also brilliant at capital allocation, operations, and strategic planning, even if we have no direct evidence of these things. Their perceived genius in one area casts a positive halo over all their other attributes. Steve Jobs was a classic example. His genius for product design and marketing was so profound that it created a massive halo effect. Investors and the public alike often attributed Apple's success solely to his individual brilliance, overlooking the contributions of a world-class team and a robust operational system. When his health declined, the company's stock price would fluctuate wildly based on rumors about his condition. This was a clear sign of extreme keyman risk, where the perceived value of the enterprise was inextricably linked to the health of one person. This is compounded by another powerful bias, authority bias. We have a deep-seated tendency to assign greater accuracy and importance to the opinion of a figure of authority. A CEO, by their very title, is a figure of authority. When a celebrated CEO makes a bold prediction about the future, we are more likely to accept it without critical examination. We suspend our own judgment and defer to their supposed expertise. The cult of the visionary CEO is built on the twin pillars of the halo effect and authority bias. Investors stop analyzing the business and start analyzing the leader's every word and action. They become followers, not analysts. Buffett's entire approach is a system designed to short-circuit these biases. His famous question, "Is this business so good that an idiot could run it?" is a powerful cognitive tool. It forces the analytical focus away from the current manager and squarely onto the underlying characteristics of the business itself. It shatters the halo effect by making the CEO's perceived brilliance irrelevant to the initial analysis. The question is not, "Is this CEO a genius?" The question is, "Does this business require a genius to succeed?" By asking this, he is performing a mental bus test. If the CEO were to get hit by a bus tomorrow, would the business's fundamental earning power be impaired? For a business with a wide economic moat, an indispensable product, and a decentralized operational structure, the answer is no. A new, competent manager could step in, and the machine would continue to function. For a business whose primary asset is the vision inside its founder's head, the answer is a catastrophic yes. Buffett's strategy is an exercise in intellectual discipline. It is a conscious decision to value the system over the superstar, the process over the personality. He recognizes that relying on a single individual is the ultimate form of speculation, a bet on a person's continued health, sanity, and brilliance. A truly great investment, he knows, is a bet on a business model so powerful that it can withstand the inevitable frailties and fallibilities of the human beings who run it. So how do you, as an investor building a portfolio or an entrepreneur building a company, systematically diagnose and mitigate this critical vulnerability? The applied mental model is the bus test protocol, a practical checklist for assessing key man risk and building genuine financial resilience. Step 1 is to identify the key man or woman. In any organization, there is almost always an individual who is perceived as the most critical. It could be the founder and CEO, a brilliant chief technology officer who holds all the product secrets, or a legendary salesperson who manages all the major client relationships. Your first task is to honestly identify this person. Whose departure would cause the most panic among investors, employees, and customers? Step 2 is the function and relationship audit. Once you've identified the key person, create 2 lists. On the first list, write down all the critical functions they perform. Do they single-handedly set the company's strategy? Do they personally approve every major capital expenditure? Are they the only one who understands the core technology? On the second list, write down the critical relationships they control. Do they have a personal, non-transferable relationship with the company's biggest customer? Are they the only person who can negotiate with key suppliers or regulators? This audit gives you a clear picture of how deeply embedded the key man risk is within the organization's operations. Step 3 is the process versus personality test. Now, for every item on your 2 lists, you must ask a crucial question. Is this function or relationship dependent on the individual's unique personality and talent, or is it governed by a documented, repeatable process? For example, if the CEO personally approves all capital expenditures based on their gut feel, that's a massive personality dependency. If, however, there is a company-wide capital allocation framework where projects must meet a certain return on investment threshold, that's a process. A resilient company systematically works to turn personality-driven functions into process-driven ones. This is the essence of building a business that can scale beyond its founder. For entrepreneurs, this means documenting everything. Create playbooks for sales, standard operating procedures for operations, and clear frameworks for decision-making. The goal is to extract the genius from your head and embed it into the organization's DNA. Step 4 is the succession plan reality check. Ask to see the company's succession plan. Is it a real, actionable document, or is it just a piece of corporate boilerplate? A serious succession plan identifies potential internal candidates for key roles years in advance. It includes a plan for their training and development. It outlines a clear protocol for an emergency transition. For many founder-led companies, the succession plan is simple: I'll never leave. This is the biggest red flag of all. Applying the bus test protocol is a vital piece of due diligence for any long-term investor. It forces you to look past the charismatic leader on the stage and examine the nuts and bolts of the organization behind them. For entrepreneurs, it provides a blueprint for building a company of enduring value, one that can outlive its creator. A business that passes this test is one that has achieved true financial resilience, where its value is located in its systems and culture, not in the fragile vessel of a single human being. This is a core component of a sound CEO mindset and effective executive decision-making. The path of the 99% is a path of hero worship. It is the wide, crowded road leading to the cult of the CEO. On this path, investors don't buy stocks, they join fan clubs. They outsource their critical thinking to a charismatic leader who promises to change the world. Their investment thesis is not based on a durable competitive advantage or predictable cash flows. It is based on the latest keynote speech, a visionary blog post, or a series of cryptic tweets. The modern market is rife with examples of this phenomenon. Look at the intense fervor that surrounded Elon Musk during Tesla's meteoric rise. For many investors, a bet on Tesla was not a bet on the future of electric vehicles or battery technology. It was a bet on Elon. His work ethic, his vision, and his sheer force of will were seen as the company's primary assets. The stock would soar or plummet based on his personal behavior. An ill-advised tweet could wipe out billions in market value. A successful rocket launch by his separate company SpaceX could send Tesla's stock soaring, a clear manifestation of the halo effect. The risk was enormous and plain to see, yet millions of investors eagerly took it, believing they were investing alongside a modern-day Thomas Edison. Another stark example is the story of WeWork and its founder, Adam Neumann. Neumann was a master storyteller. He wasn't selling office space. He was selling a global community, a revolution in the way we work and live. He was a captivating, messianic figure. Investors, including sophisticated private equity firms, were so entranced by his vision and charisma that they poured billions of dollars into a simple office rental business at a valuation that defied all logic. They ignored the gargantuan losses, the questionable corporate governance, and the flimsy business model. They were investing in the cult of personality. When Neumann's erratic behavior came to light and the story fell apart, the company's valuation collapsed by over 90% almost overnight. The investors weren't left with a bad business, they were left with an empty story. The danger of joining the cult of the CEO is that it creates a powerful emotional bond to the investment. When you invest in a person, any criticism of the business feels like a personal attack on your hero, and by extension, on your own judgment. This makes it incredibly difficult to sell when things go wrong. Instead of rationally assessing the deteriorating fundamentals, investors engage in motivated reasoning, defending their hero and, quote, holding on for the long term, even as their capital evaporates. This is the antithesis of Buffett's dispassionate, business-first approach. He admires great managers, but he does not worship them. His loyalty is to the principles of value and safety, not to any individual. The path of the 99% is to fall in love with a great storyteller. Buffett's path is to find a great business, and he's perfectly happy if the person running it is a boring, methodical operator who never gives an interview. The consequence of this hero worship is a portfolio built on sand. Its value is tied not to the solid foundation of a resilient business model, but to the shifting fortunes and fragile ego of a single person. It is a strategy that mistakes charisma for competence and a good story for a good investment. The direct financial connection of de-risking genius is a profound and often underappreciated reduction in portfolio volatility and a lower long-term cost of capital for the business. These are not abstract concepts. They are tangible financial advantages that contribute directly to superior returns and enhanced financial resilience. First, let's consider volatility. A stock's price is a reflection of the market's perception of its future earnings, discounted by its perceived risk. When a company's success is heavily tied to a single key man, the perceived risk is enormously high. The market has to price in a multitude of personal risks: the risk of the CEO's health failing, the risk of them leaving for a competitor, the risk of them suffering from burnout, or the risk of them becoming embroiled in a personal scandal. Every news headline about the CEO's health or personal life becomes a major risk factor for the stock. This creates a stock price that is inherently volatile. It will experience sharp swings based on news that has nothing to do with the company's underlying business operations. A portfolio composed of such stocks will be a stomach-churning roller coaster ride. Conversely, a business that has passed the bus test, one with a strong decentralized system and a deep bench of management talent, is perceived by the market as being fundamentally less risky. The company's future earnings are seen as a function of its durable business model, not the health of one individual. This results in a stock price that is far more stable. It will still fluctuate with the broader market and its own business results, but it is insulated from the violent swings caused by CEO-specific news. Over a long-term investing horizon, this lower volatility has a powerful psychological benefit. It allows the investor to stick with their portfolio strategy during turbulent times, avoiding the panic selling that destroys so much wealth. Second, this reduction in perceived risk leads to a lower cost of capital for the business itself. When a company needs to raise money, either by issuing bonds, debt, or new shares, equity, the price it has to pay is determined by the market's assessment of its risk. Lenders and investors demand a higher return for taking on more risk. A company with severe key man dependency will have to pay a higher interest rate on its bonds, because creditors know that the departure of the key person could jeopardize the company's ability to repay its debts. Similarly, when it issues new stock, it may have to do so at a lower price to attract investors wary of the risk. A company with a resilient, system-driven model will be able to borrow money at more favorable rates and issue equity on better terms. This lower cost of capital is a direct competitive advantage. It means more of the company's operating profit flows through to the bottom line as net income instead of being paid out as interest. It allows the company to fund growth projects more cheaply than its more fragile competitors. Over time, this advantage compounds, allowing the resilient company to grow faster and more profitably. The apathetic spreadsheet may not have a line item for key man risk, but its effects are powerfully visible in the reduced volatility of the stock price and the enhanced profitability driven by a lower cost of capital. This is the tangible financial reward for investing in systems, not superstars. Pillar 4. Capital-light compounding, the magic of low-maintenance moats. In the autumn of 1963, the financial world was rocked by a scandal of epic proportions. It was called the Salad Oil Scandal. A company in New Jersey called Allied Crude Vegetable Oil, run by a man named Tino DeAngelis, had perpetrated a massive fraud. DeAngelis had borrowed hundreds of millions of dollars from various Wall Street firms, using his company's inventory of salad oil as collateral. The problem was, the oil didn't exist. His massive storage tanks were mostly filled with seawater, with only a thin layer of oil floating on top to fool inspectors. When the fraud was discovered, Allied Crude collapsed, taking several of its lenders down with it. The biggest and most respected victim was American Express. A subsidiary of Amex had written warehouse receipts guaranteeing the existence of the salad oil, and now the company was on the hook for potentially catastrophic losses. Wall Street panicked. The consensus was that American Express would be wiped out. How could anyone ever trust their warehouse receipts again? More importantly, investors worried that the scandal would taint the company's core businesses, their iconic travelers, checks, and credit cards. The stock price was decimated, plummeting by nearly 50%. In the midst of this chaos, a young Warren Buffett saw an opportunity. Instead of panicking with the crowd, he decided to do his own research. He didn't just look at the financial statements. He went out and did some on-the-ground investigation. He visited restaurants and banks. He talked to merchants and customers. He wanted to know if the scandal had actually damaged the underlying business. What he found was that it hadn't. Not at all. Customers were still using their Amex credit cards. Travelers were still buying and using the travelers' checks with complete confidence. The scandal, while a huge financial hit to one subsidiary, had not dented the public's perception of the core American Express brand. Buffett then dug deeper into the economics of that core business, and what he saw was a thing of beauty. The traveler's check business was a financial marvel. American Express would sell a customer a $100 traveler's check and receive $100 in cash. But the customer might not cash that check for weeks, months, or even years. In the meantime, American Express got to hold and invest that money, what Buffett called the float, for free. The credit card business was similarly brilliant. It was a royalty on commerce. Every time a customer swiped their card, Amex got a small percentage of the transaction. The beauty of these business models was that they were incredibly capital light. They didn't require massive, ongoing investments in factories, machinery, or inventory to grow. To expand the traveler's check business, they just needed to print more small pieces of paper. To expand the credit card business, they just needed to sign up more merchants and cardholders. The business gushed cash, and that cash wasn't needed to maintain its competitive position. Convinced that the market was wrongly punishing a phenomenal business for a one-time ring-fenced disaster, Buffett invested 40% of his partnership's capital, a massive bet, into American Express stock. Within 2 years, the stock had tripled. The salad oil scandal became a foundational story in Buffett's education. It taught him the immense power of a business with a capital-light economic moat. He saw that the real magic of compounding happens when a company can generate high returns on its capital and doesn't require a large amount of capital to operate in the first place. These are the true cash-generating machines, the cornerstones of a portfolio built for passive income and long-term wealth creation. Why are capital-intensive businesses so often poor long-term investments, even when they appear profitable? The answer lies in a pair of insidious psychological biases that afflict the managers of these companies: the endowment effect and the sunk cost fallacy. The endowment effect is our tendency to overvalue something simply because we own it. A manager who oversees a company with billions of dollars invested in factories, machinery, and physical infrastructure will instinctively view those assets as more valuable and more strategically important than an objective outsider would. This psychological attachment makes it difficult for them to make rational decisions, such as shutting down an underperforming factory or selling off a legacy division. They are emotionally endowed with the assets, leading them to protect and defend them even when they are a drain on shareholder capital. This is closely related to the sunk cost fallacy, which is the tendency to continue with a project or investment not because it has good future prospects, but because you have already invested a significant amount of money, time, or effort into it. This is the throwing good money after bad phenomenon. In a capital-intensive industry like airlines or auto manufacturing, managers are constantly faced with this trap. An airline might have already spent $1 billion on a new fleet of jets that are proving to be fuel inefficient. The rational decision might be to sell them at a loss and buy a more efficient model. But the sunk cost fallacy makes this feel like an admission of a colossal failure. So they continue to operate the inefficient fleet, pouring more money into maintenance and high fuel costs, justifying the decision by saying we've already invested so much in them. Buffett's preference for capital-light businesses is a brilliant strategic maneuver that almost completely sidesteps these psychological traps. A manager of a capital-light business like a software company or a royalty company has far fewer opportunities to fall victim to these biases. Their primary assets are intangible: brand, patents, or code. Their decisions are not about whether to keep a billion-dollar factory running. They are about how to allocate the gusher of free cash flow the business produces. This shifts the entire managerial mindset from one of asset protection to one of intelligent capital allocation. The manager's job is not to defend sunk costs, but to find the highest possible return for the next dollar of profit. Furthermore, Buffett's focus on capital-light models protects him as an investor from managements who do succumb to these biases. He knows that in a capital-intensive business, a huge portion of the cash generated by operations will be automatically consumed by maintenance capital expenditures, the money required just to keep the existing asset base competitive. This money is not available to return to shareholders. It is a mandatory reinvestment that often earns a very low return. By choosing businesses that don't have this built-in capital consumption engine, he ensures that a much higher percentage of the reported earnings is converted into actual, distributable cash. This is a subtle but profound psychological and financial advantage. It is a filter that weeds out businesses where managerial biases are most likely to destroy shareholder value, and focuses on those where rational capital allocation can work its compounding magic. To truly understand and apply this principle, you need a mental model that allows you to look past the reported net income on an income statement and see the true cash-generating power of a business. Buffett provides this tool with his concept of owner earnings. This is the blueprint for identifying capital-light compounders. Owner earnings is a more honest measure of profitability than the standard accounting metric of net income. Here is the step-by-step process to calculate and use it in your own stock picking. Step 1 is to start with net income. This is the bottom-line figure you find on every company's income statement. It's the starting point, but it's often misleading because it includes various non-cash expenses and doesn't fully account for the capital needed to run the business. Step 2 is to add back all non-cash charges. The most common of these are depreciation and amortization, often found on the cash flow statement. Accountants subtract these charges to represent the gradual wearing out of assets. However, this is an accounting fiction. No cash actually leaves the company for depreciation. So to get a clearer picture of the cash being generated, we must add these non-cash charges back to net income. At this point, many investors stop and use a metric called operating cash flow. But this is a mistake, as it ignores the real cash that must be spent to keep the business healthy. Step 3, the crucial step, is to subtract the average annual amount of maintenance capital expenditures. This is the part that requires some judgment. Capital expenditures, or CapEx, is the money a company spends on physical assets like buildings and equipment. It's found on the cash flow statement. However, CapEx can be divided into two types: growth CapEx, which is money spent to expand the business, like building a new factory to enter a new market, and maintenance CapEx, which is the money required just to maintain the company's existing position, like replacing old machinery or updating facilities. Net income already accounts for depreciation, which is an asterisk estimate ties of maintenance CapEx, but Buffett prefers to use the actual, long-term average cash figure. To estimate this, you can look at the company's CapEx over the past 5 to 10 years. In a business that isn't growing rapidly, most of the CapEx will be for maintenance. For a growing business, you may need to read the annual reports, where management sometimes discusses the breakdown. The key is to find a conservative, realistic estimate of how much cash must be spent each year just to stay in the same place. The formula is owner earnings equals net income plus depreciation / amortization maintenance CapEx. The resulting number is Buffett's estimate of the true cash profit available to the owners of the business. This is the cash that can be used to pay dividends, buy back stock, or make acquisitions without harming the core business. When you apply this model, the difference between a capital-light business and a capital-intensive one becomes starkly clear. A software company might have $100 million in net income and only $5 million in maintenance capex. Its owner earnings would be very close to its net income. An airline might have $100 million in net income but need to spend $200 million a year on new planes just to keep its fleet current. Its owner earnings would be massively negative. The airline looks profitable on paper, but it is actually a giant cash-consuming machine. Using the owner earnings model is a foundational practice of serious value investing. It allows you to peel back the layers of accounting and see the true economic engine of the business. It is the analytical tool that helps you avoid the capital traps and identify the true capital-light compounding machines. The path of the 99% is a path of seductive but ultimately destructive revenue growth. The average investor is mesmerized by the top line of the income statement. They see a company whose sales are growing at 30% per year and they immediately assume it must be a great investment. They fall for what can be called the capital expenditure treadmill. A business on this treadmill is one that must constantly spend enormous sums of money on capital assets just to maintain its competitive position and generate growth. It's a business that is running as fast as it can just to stay in the same place. The airline industry is the quintessential example. An airline might post $1 billion in profit in a good year, but in that same year it might have to spend $2 billion on new, more fuel-efficient airplanes, simply because its competitors are doing the same. If it doesn't make this investment, its cost structure will become uncompetitive and it will lose market share. So despite being, quote, profitable, the business actually consumed $1 billion of cash. That cash is gone forever, locked up in a depreciating asset. The shareholders will never see it. Another classic example is the auto industry. A car company must constantly spend billions on retooling its factories for new models, developing new engine technologies, and building out electric vehicle infrastructure. The competition is so fierce that this massive capital expenditure is not optional. It is the price of admission to the game. Many companies in the semiconductor industry also live on this treadmill, forced to spend tens of billions on new fabrication plants every few years to keep up with Moore's law. Investors in these businesses are often lured in by the impressive revenue figures and the tangible nature of the assets. It feels good to own a piece of a company that makes real things: planes, cars, and chips. They see the growth, but they fail to see the colossal cost of that growth. They don't calculate the owner earnings. They are like a person who is excited about their new high-paying job, but ignores the fact that they have to spend 80% of their salary on a fancy car and wardrobe just to keep that job. The disastrous consequence of investing in these businesses is that shareholders rarely get to participate in the company's success. The cash generated by the business is immediately plowed back into the asset base, not returned to the owners. The returns on this reinvested capital are often pitifully low, sometimes not even covering the company's cost of capital. This is how a company can grow its revenues for decades while creating zero long-term value for its shareholders. General Motors is a prime example of this, a company that was a global behemoth for a century, but whose long-term stock performance was abysmal due to its capital-intensive nature. The 99% chase revenue. The wise investor, following Buffett's lead, seeks free cash flow. This requires looking past the glamorous top line and doing the hard work of understanding the capital requirements of the business. It means choosing the boring but cash-gushing royalty company over the exciting but cash-burning airline. This choice is a fundamental dividing line between a portfolio built for show and a portfolio strategy built for dough. The ultimate financial advantage of a capital-light business model is captured in two of the most important metrics in all of finance: return on invested capital, ROIC, and free cash flow, FCF generation. Understanding how these metrics connect to the capital-light principle is to understand the very engine of financial compounding. Return on invested capital is a measure of how efficiently a company is using its capital to generate profits. The formula is typically net operating profit after tax, NOPAT, divided by invested capital, which is the sum of the company's debt and equity. A capital-light business has a massive, built-in advantage in this calculation. By its very definition, the denominator of the equation, the invested capital, is very small. A company like See's Candies has very little capital invested in its business. It needs its stores, some candy-making equipment, and a bit of working capital. Its main asset, the brand, isn't even on the balance sheet. Because the I in ROIC is so small, even a modest amount of profit can generate a spectacular return. If a business earns a $10 profit on an invested capital base of $100, its ROIC is 10%. If a capital-light business earns that same $10 profit on an invested capital base of just $20, its ROIC is a staggering 50%. High ROIC is the hallmark of a truly great business. It signifies a company with a strong competitive advantage, one that can deploy capital and earn returns far in excess of its cost of capital. This is what creates genuine economic value. A capital-intensive business with its huge denominator of invested capital has to work much harder to generate a respectable ROIC. This superior ROIC flows directly to the creation of massive free cash flow. As we saw with the owner earnings model, a capital-light business has very low maintenance capital expenditure requirements. Therefore, a much larger portion of its operating cash flow is converted into free cash flow, cash that is truly free to be returned to shareholders. Let's make this tangible. Imagine two companies, a capital-light software company and a capital-intensive manufacturing company. Both generate $100 million in operating cash flow. The software company only needs to spend $5 million on new servers and computers, maintenance CapEx. It is left with $95 million in free cash flow. The manufacturing company needs to spend $80 million on upgrading its machinery and facilities. It is left with only $20 million in free cash flow. Both companies are the same size in terms of cash generation, but the software company has nearly 5 times as much cash available to reward its owners. This river of free cash flow is the fuel for long-term shareholder returns. It is the source of dividends that create passive income. It is the ammunition for share buybacks that increase per-share value. It is the dry powder for making value-accretive acquisitions. A business that consistently generates high returns on capital and converts a high percentage of its earnings into free cash flow is a compounding machine. It is an asset that will, over time, create enormous wealth for its owners. This is the direct, quantifiable financial connection. The abstract principle of capital light translates directly into the hard numbers of superior ROIC and FCF, which in turn create a resilient, high-performing investment for the long term. Pillar 5: the managerial litmus test, competence and integrity over charisma and vision. In the sweltering summer of 1991, Wall Street was rocked by a scandal that threatened to bring down one of its most powerful firms, Salomon Brothers. Berkshire Hathaway was Salomon's largest shareholder, with a $700 million preferred stock investment. The scandal was a bombshell. Salomon's head of government bond trading had been caught submitting false bids in U.S. Treasury auctions, a flagrant violation of the law that jeopardized the firm's very license to operate. The firm's charismatic and hard-charging CEO, John Gutfreund, who had once been dubbed the King of Wall Street, had known about the transgressions for months and had failed to report them to the authorities. The crisis was existential. Regulators were circling, clients were fleeing, and the firm was facing a liquidity crisis that could bankrupt it within days. In this moment of extreme peril, the U.S. Treasury Secretary, Nicholas Brady, made an extraordinary request. He called Warren Buffett and asked him to step in as interim CEO to save the firm. Buffett, who loathed the culture of Wall Street, reluctantly agreed, knowing that his entire personal reputation and a huge chunk of Berkshire's capital were on the line. His first act was to force the resignation of John Gutfreund. He needed a new leader to run the day-to-day operations while he dealt with Washington. He could have chosen any of the superstar traders or rain-making investment bankers at the firm. Instead, he made a surprising choice. he appointed a man named Derek Mon. Mon was not a household name. He was the competent, steady, and decidedly uncharismatic head of Salomon's Tokyo office. He was known not for his swashbuckling trades, but for his integrity, his attention to detail, and his calm demeanor. He was an operator, not a visionary. Buffett's instructions to his new management team, delivered to the terrified employees of Salomon, became legendary. He said, "Lose money for the firm, and I will be understanding. Lose a shred of reputation for the firm, and I will be ruthless." This single sentence perfectly encapsulated his managerial litmus test. He was not primarily concerned with short-term profits. He was obsessed with long-term reputation and institutional integrity. He knew that the firm's immediate survival depended not on some brilliant new trading strategy, but on regaining the trust of the government and the financial markets. Derek Mon was the perfect man for that job. He was a steward, not a star. He focused on implementing rigorous new compliance controls and cooperating transparently with investigators. The story of the Salomon Brothers crisis is the ultimate foundational anecdote for understanding the kind of management Buffett truly values. When faced with a five-alarm fire, he didn't seek out a charismatic arsonist. He sought a competent and trustworthy fire chief. He proved that in the moments that truly matter, integrity is not a soft skill. It is the most valuable and practical asset a leader can possess. He looks for managers who see themselves not as geniuses or visionaries, but as stewards of the owner's capital, with a primary duty to protect the institution's reputation and allocate its resources rationally. This is the final and most crucial screen in his investment process. The business world and the investors who follow it are often seduced by the archetype of the bold, charismatic, and visionary leader. We are drawn to confidence, to big promises, and to the kind of personality that can command a room. This attraction is fueled by a powerful set of cognitive biases, primarily the overconfidence bias and the Dunning-Kruger effect. The overconfidence bias is the pervasive human tendency to have excessive faith in our own judgments and abilities. In corporate leaders, this bias can be amplified by a string of successes. A CEO who has overseen a period of rapid growth or a successful product launch can begin to believe they are infallible. They start to trust their gut more than data, take on excessive risk, and dismiss dissenting opinions. They believe their own hype, and this overconfidence often precedes a great fall. The Dunning-Kruger effect is a related bias where people with low ability in a certain domain tend to overestimate their competence. A CEO who is brilliant at marketing might, through the Dunning-Kruger effect, believe they are also an expert in manufacturing or finance, leading them to make disastrous operational or capital allocation decisions. They lack the self-awareness to recognize the boundaries of their own expertise. Buffett's managerial litmus test is a powerful antidote to these biases. He actively seeks out leaders who display the opposite traits: humility, rationality, and a keen awareness of their own limitations. He looks for what he calls the circle of competence in his managers. He wants leaders who know what they know, and more importantly, know what they don't know. A manager who honestly admits their mistakes in an annual report is, in Buffett's view, far more trustworthy than one who glosses over failures with corporate jargon. Admitting a mistake signals rationality and a commitment to learning, whereas constant self-promotion signals an ego that is likely to be infected with overconfidence. He is systematically filtering for a specific CEO mindset, one that is grounded in a deep respect for reality. He wants managers who are passionate about the business, not about building their own personal brand. He famously said he looks for three things in a manager: intelligence, energy, and integrity. And he warns that if they don't have the last one, the first two will kill you. A smart, energetic person without integrity will eventually use their talents to cheat the owners. Buffett's focus on integrity is not a moral preference. It is a pragmatic risk management strategy. He understands that a manager's true character is revealed in how they handle the company's capital and how they communicate with its owners. A manager who is obsessed with short-term stock performance, who uses accounting tricks to manage earnings, or who pays themselves exorbitant salaries unrelated to performance, is failing the integrity test. By selecting for humble, rational, and high-integrity operators, Buffett is immunizing his portfolio against the destructive consequences of managerial ego and overconfidence. He is betting on the quiet competence that builds enduring value, not the loud charisma that so often precedes its destruction. How can you, as an investor, systematically evaluate the quality of a company's management without ever meeting them in person? The answer lies in the public record they produce every year. The applied mental model for this is the shareholder letter analysis. The annual letter to shareholders is the single best window into the mind of a CEO. It is where they have a chance to speak directly to the owners of the business, and the language they choose, the topics they focus on, and the things they omit are incredibly revealing. Here is a practical, step-by-step guide to analyzing a shareholder letter like a world-class investor. Step 1 is the plain English test. Read the first few pages of the letter. Is the CEO communicating in clear, simple language like a person explaining a business to a partner? Or is the letter filled with corporate jargon, buzzwords like synergy, leveraging, and paradigm, and convoluted sentences? Buffett is a master of the former. His letters are models of clarity. A CEO who writes clearly is likely a CEO who thinks clearly. A CEO who hides behind jargon is often trying to obscure a lack of clear strategy or poor performance. Honesty and clarity go hand in hand. Step 2 is the confessional test. Scan the letter for any admission of mistakes. Does the CEO openly discuss business decisions that went wrong during the year? Do they take personal responsibility, explain what they learned, and outline how they will avoid similar errors in the future? A letter that is a relentless stream of self-congratulation is a major red flag. It signals an arrogant culture where mistakes are buried, not learned from. A manager who can publicly admit to being wrong is a manager you can trust. This is a critical indicator of both integrity and rationality. Step 3 is the capital allocation litmus test. This is the most important part of the analysis. How much of the letter is dedicated to explaining how the company handled its capital? The single most important job of a CEO is capital allocation. A great CEO will spend a significant amount of time in their letter discussing their framework for this. Do they talk about the returns on recent investments? Do they explain the rationale behind share buybacks, acquisitions, or dividend policies? Do they discuss their hurdle rates for new projects? If the CEO spends 10 pages talking about new products and only a single sentence on capital allocation, it suggests they don't view it as their primary responsibility. This is a sign of a poor executive decision-making framework. Step 4 is the alignment of incentives check. In the company's proxy statement, which is released alongside the annual report, look for the section on executive compensation. Are the CEO's bonuses tied to metrics that actually create long-term shareholder value, like growth in per-share intrinsic value or return on invested capital? Or are they tied to vanity metrics like the size of the company's revenue or short-term stock price movements? You want a CEO whose personal financial success is directly and inextricably linked to the success of the long-term owners of the business. By performing this shareholder letter analysis across 5 to 10 years of a company's history, you can develop a remarkably accurate portrait of the CEO's character and competence. It is a powerful form of quality investing due diligence that allows you to assess the pilot of the ship without ever setting foot on the bridge. The path of the 99% is to be impressed by the empire builders. An empire-building CEO is a leader motivated not by the rational pursuit of per-share shareholder value, but by an egotistical desire to preside over the largest possible enterprise. They are obsessed with size, the size of their revenues, the number of their employees, their ranking in the Fortune 500. This obsession almost invariably leads to the destruction of shareholder wealth. The empire builder's primary tool is the large, headline-grabbing acquisition. They are constantly on the hunt for transformative deals that will vault their company into a new league. The problem is that these large acquisitions are notoriously difficult to execute successfully. The empire builder, driven by ego and a desire to win the deal, almost always overpays. They get caught up in bidding wars and pay a massive premium over the target company's intrinsic value, a phenomenon known as the quote, 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 quote. The most infamous example of this in corporate history is the disastrous AOL-Time Warner merger in 2000. At the peak of the dot-com bubble, Steve Case, the CEO of AOL, used his company's massively inflated stock to acquire the old media giant Time Warner. It was hailed as a visionary deal that would define the future of media. It was the ultimate act of empire building. The reality was a catastrophic clash of cultures, a failure to realize any of the promised synergies, and one of the largest value destructions in corporate history. The combined company ended up writing off nearly $100 billion, and the stock price collapsed, wiping out legions of investors who had bought into the empire builder's grand vision. The empire-building CEO exhibits a specific set of behaviors. They talk incessantly about revenue growth, but rarely about returns on investment. They favor growth by acquisition over the slower, more methodical process of organic growth. Their shareholder letters are filled with pronouncements about market share and global footprint. They often take on huge amounts of debt to finance their expansionary ambitions, making the company's balance sheet fragile. Investors on the path of the 99% are easily seduced by these leaders. The constant action, the big deals, and the bold proclamations are exciting. It feels like being part of a winning team that is constantly advancing. They mistake activity for progress. They fail to do the math on the acquisitions, to see that buying a company for twice its value is a surefire way to lose money, no matter how strategic it seems. The antithesis is the rational, value-focused manager that Buffett seeks. This manager abhors dilutive acquisitions. They would rather sit on a growing pile of cash for years, waiting for a single, fairly priced opportunity, than constantly do deals for the sake of growth. They understand that their job is not to build the biggest empire, but to increase the per-share intrinsic value of the business they manage. This often means being patient, being disciplined, and sometimes doing nothing at all. This patient, rational approach is often seen as boring by the market, but it is the true path to creating sustainable, long-term wealth. The empire builder creates a brief, dazzling fireworks display that ultimately leaves investors in the dark. The direct financial connection between superior management and shareholder returns is found in the art and science of capital allocation. Over the long term, the single greatest determinant of a company's per-share value is the series of decisions its management makes about what to do with the earnings the business generates. A management team with competence and integrity will create a virtuous cycle of value creation. A management team of empire builders or incompetence will destroy value, even if they are running a decent underlying business. Let's trace the financial impact directly. A well-managed company generates a stream of owner earnings. The CEO then has 5 possible choices for that cash. 1. Reinvest it back into the core business. 2. Acquire another business. 3. Pay down debt. 4. Pay a dividend. 5. Buy back stock. A rational CEO, one with the mindset Buffett prizes, will evaluate these 5 options like a professional investor. They will only reinvest in the core business if they can earn a high incremental return on that capital, well above the company's cost of capital. They will only make an acquisition if the target can be bought for a price below its intrinsic value, and if it will add to the per-share value of their own company. If no such high-return opportunities exist, they will return the capital to shareholders. They will do this by paying a dividend, which provides a direct cash return, or by buying back their own stock. A stock buyback, when done at a price below the company's intrinsic value, is a powerful way to increase the value of each remaining share. It's like a company buying a dollar bill for 90 cents. Every remaining shareholder's piece of the pie gets a little bigger and a little more valuable. This disciplined, value-based approach to capital allocation directly maximizes the growth in per-share intrinsic value over time. This is the ultimate metric of success. It is not about growing revenues or profits in absolute terms. It is about making each individual share of the company more valuable. Now consider the empire-building CEO. They will take that same stream of owner earnings and consistently make poor capital allocation decisions. They will reinvest in low-return projects just for the sake of growth. They will overpay for flashy acquisitions, destroying value on day one. Their decisions will lead to a declining return on invested capital. The company might get bigger, its revenues might grow, but the value of each individual share will stagnate or even decline. This difference in capital allocation skill is the primary reason why two companies in the same industry, with similar starting positions, can have vastly different long-term stock performances. The superior capital allocator creates a compounding machine for shareholders. The poor capital allocator presides over a capital-destroying treadmill. When you invest in a company, you are not just buying its assets and its current earnings stream. You are hiring its management team as the stewards of your capital. Choosing a team that has a demonstrated history of rational and shareholder-friendly capital allocation is the single most important decision you can make for your long-term portfolio strategy and your pursuit of genuine financial resilience. You have just spent the last hour forging a new and powerful lens through which to view the world of business and investing. You have moved beyond the noise of the market and absorbed a foundational principle from the mind of the world's greatest investor. You now understand that the most resilient, predictable, and profitable businesses are not the most complex, but the most simple. You have acquired the mental tools to identify a fortress business model, to recognize the power of an indispensable product, to de-risk the cult of the CEO, to find capital-light compounding machines, and to judge the character of a management team from afar. This is not just trivia. It is a complete operational framework for making superior long-term financial decisions. You have effectively installed a new operating system for your investing mind. But here is the critical truth. What you have just mastered is one powerful load-bearing pillar in a much larger architecture. Warren Buffett's success is not the result of a single insight, but a latticework of interconnected mental models that support and amplify one another. Understanding the power of a simple business is crucial, but its true power is only unlocked when you connect it to the principles of market psychology, valuation, and the emotional discipline required to act rationally when others are driven by fear and greed. You have built a powerful engine, but for it to truly take you to your destination of financial freedom, it must be connected to a transmission, a chassis, and a steering wheel. The video that is now appearing on your screen is not an accident. It has been selected for you because it represents the next piece of the map, the missing link in this chain of logic. Think of the knowledge you've just gained as a key. That video is the lock it was designed to open. It will take the principle of the simple business you've just mastered and connect it to the next critical component of the system, revealing how these ideas work together in a powerful, reinforcing loop. The journey of 1,000 miles begins with a single step, and you have just taken a giant one. But the path to true mastery requires the next one, and the one after that. The choice is not about watching another video. It is about whether you are the kind of person who starts a journey and sees it through to the end. It is a choice between being a tourist in the world of knowledge or becoming a true architect of your own financial future. For those who are serious about completing their mental arsenal, the path forward is clear. Click and continue the ascent.